The markets may be disappointed with the SCT announced in the budget, but the policy measures which have been announced by the finance minister turns out to be a very prudent one, and this budget is a prudent one for quite a few reasons. The first one being they have kept a 10% nominal GDP growth rate, which is pretty much in line with the street there. The street was looking for a capex growth, which is come at 12.22 lakh crores versus the previous 11 lakh odd crores, which is there. In the defense space, there is an increase in budget for defense capital outlay at 2.19 lakh crores compared to 1.8 lakh crores. So in capex, there are two things which have come in. One, capex in general, and the second one being the defense capex which is there. And the third one is in terms of railways, where the growth is roughly around 10% in terms of capital expenditure coming for the railways there. So from a capital expenditure point of view, the numbers are pretty much good in terms of the expenditure that the government is trying to do. But it has its negative effects as well. The government is moving to a debt framework where debt to GDP has been predicted expected to be at around 50% plus or minus 1 by 2031. Now that basically means that because the government is looking at higher capex over a period of time, they are pegging the entire debt to GDP at 55.6%, which is slightly higher than what the street was expecting. The street was expecting around 55.2% of debt to GDP, which is there. And that would mean some additional 2 lakh crores of borrowing which is going to come into the markets in the next financial year, thereby putting some pressure on bond yields and on some of the banks which will be forced to buy those bonds from the market there. So from that point of view, it may be a collateral impact that may come in there. But fiscal deficit at 4.3% is as per expected lines as compared to 4.4%. There is the finance minister, which is also looking at over 3 lakh crores of money coming in as dividend from RBI and the banks in FY27. She has also tabled the 16th Finance Commission, whereby the entire the allocation to the states has been maintained at 41%, whereby there is some certainty of what the growth numbers are going to be. While the nominal growth is very conservative at this point in time of 10%, the numbers which are now coming in, like the numbers that came in for January of GST at 1.93 lakh crores, it shows that there is some buoyancy which is there in the market. There could be a chance that the buoyancy will lead to a higher tax collection going forward, because consumption is increasing after the GST 2.0 that happened in September of 2025 there. So overall, there has been some relaxation with respect to buybacks. There is some relaxation with respect to tax collected as source. There is also incentives for labor-intensive export sectors, which is there. And from a PSU point of view, there is a high-level committee which has been formed by the government to look at how PSUs can be scaled up. There is a scope which will be brought out by the finance ministry there, and then PSU real estate monetization is something which has come in. So overall, it seems to be a very prudent budget which has come in from there. The only disappointment for the street would be the STT hike, but that's understandable because a lot of speculation is going on in the market, and a lot of capital of retail investors are going into losses that could be stemmed now, and that can then be diverted into cash market, or for that matter IPOs, or for that matter into consumption or bank deposits. So that's, from that point of view, it seems to be a very well thought out calibrated move on SCT, and that's why I think the budget is prudent which has come out.